Good afternoon. Thank you so much for joining us at the Share Conference. I'm Dana Telsey, and I'm thrilled to have with us today Tom Chubb, the Chairman, CEO, and President of Oxford Industries. Tom has been at Oxford for just over 20 years, and when we think about what Oxford Industries is, it has brands that make people happy, from Tommy Bahama to Lilly Pulitzer to Southern Tide, and smaller brands that are also growing, like Duckhead and Beaufort Bonnet. We think about what's been happening recently. Their business that includes a diversified portfolio of multi-channel, high-margin lifestyle brands. We've certainly seen the consumer delighted to spend, want to spend, and the products that Oxford has been quite appealing. I'd love to open it up to Tom to share with us his perspective, the momentum that you've had in the first half of the year. What do you see? Where is it coming from? And can it continue? Tom, thank you so much for joining us today.
Okay, thank you, Dana, and thank you so much for hosting. It's always a pleasure to be with you. You do an incredible job as an analyst in our industry. We have such admiration for the work that you and your firm do, and we love talking to you. So we, as you said, are having just an absolutely terrific year. A couple of weeks ago, we reported our second quarter. And it was an amazing quarter. It was our best quarter ever with record sales, gross margin, operating margin, and adjusted EPS. And I think when you step back from it, those results are really driven by our incredible team of people for whom we're so grateful. So many of our peers reported very strong numbers. In fact, probably most of them did. And I don't think there's any doubt that market conditions right now are favorable. As you said at the top, the consumer is out there, they're spending money, and we are benefiting from those favorable market conditions. But I genuinely believe that a huge part of the results are attributable to much more than that, and are actually attributable to the things that we try to stay focused on all the time. So first and foremost is our objective of delivering long-term shareholder value, which of course implies a laser focus on doing what's right for shareholders. But if we're going to do that on a long-term basis, we also have to take into account our other stakeholders, our employees, customers, suppliers, the communities where we do business, in even our competitors, and we have to conduct ourselves with ethics, integrity, and respect for people at all times. And it's easy to lose sight of some of those things during tough times, but we did not do that last year. Likewise, we stuck to our strategy of owning a portfolio of lifestyle brands that can deliver sustained profitable growth. And in fact, we even made moves to strengthen the portfolio during the year with our decision to exit a legacy business, Lanier Apparel, that while a great business run by a great group of people, was really not well aligned with our strategy. So we cleaned up the strategy. And last but not least, we stayed focused on our purpose as a company, which, as you said at the top, is making people happy. Every single one of our brands is a happy brand. They're all about evoking memories and thoughts of happy times and happy places and being with the people that you love. And what we know is that when we focus on delivering happiness to people, we win. And so last year, as we were in the worst part of the pandemic, obviously, we did what we had to do to get through the year in terms of protecting our liquidity, protecting our brands, and looking out for our people. But we were also very determined to emerge from the pandemic stronger than we went into it. And while the country and the world have not totally emerged from the pandemic yet, we are certainly in a much better place than we were a year ago and 18 months ago. And so that focused on emerging stronger, I think, has paid off. And some of the things that we did to emerge stronger included really making sure that our imagery was at the top of its game, that we were selling the dream of our brands and not just selling merchandise, that our merchandising and our assortment were better than ever and aligned to the times. And we can talk about that more and how we've improved merchandising. We had multi-year projects underway before the pandemic to improve our utilization and optimization of inventory. And those really came into being in the pandemic and have borne great results for us. We also had multi-year projects to improve our sourcing that have really paid off. And then our efforts on the digital front have really paid off in terms of driving that digital business and the overall business, as well as in this point in time, almost all business has a digital element to it, even if it's not actually transacted online. So I think by staying focused on the long-term big picture goals and at the same time that we were navigating our way through the very difficult pandemic conditions, we have been able to emerge better than ever, and I think have delivered sustainable improvements to our business. So while we are probably getting some short-term benefit, we also believe that there's some very sustainable improvements that we've made to the business over the last 18 months that will benefit us for the rest of the year as well as years going forward.
Tell us about some of these sustainable improvements. That word keeps coming up. What do you see as sustainable and the opportunity that way?
Well, I think I'd start, and this is a very important one, and in some ways it's one of the most fundamental ones, and it's that idea of making sure that we're selling the dream of our brands, the happiness that our brands offer, not just the products themselves. So we talk about our brands being happy brands and delivering happiness to consumers. Well, we do that through our products and our experiences, but also through the imagery and the way that we present our brands. And I think what we found as we got into the pandemic was that in the couple of years prior to that, we'd maybe gotten a little bit too serious, a little bit too product focused, a little bit too much transactional in the way that we were communicating our brands. And what we found is that especially during the pandemic, it was a good reminder that what our consumers really want is they want to be taken away to a different place and to a happy place. So if you look at our websites now, and I would encourage you to go look at the Tommy Bahama website or the Lilly Pulitzer, any of our websites, we're really presenting the dream of our brands and the beautiful imagery and taking people to a different place. So that's something that we worked on very deliberately. I think you can see the results visually if you look at our websites or our social media or other communications or emails, that kind of thing. And you also see it in our results, and that I think that's happening, helping to drive some of the phenomenal results that we're getting. So that's one, but there's more.
And tell us about e-commerce. That
e-commerce is another great example. During the second quarter, our e-commerce business was up 49% over the second quarter of 2019. That is a huge increase. This year, we expect our e-commerce business to be about a third of our business, so somewhere around $350 million for the total year. It is a highly profitable business, Dana. Unlike some people that will talk about e-commerce being dilutive to their operating margins, we actually love e-commerce, and it has everything to do with our high gross margins and our high average order size, which combine to provide a lot of contribution out of each box that we ship to the customer, and plenty of room to absorb the freight and handling costs that are associated with e-commerce. So e-commerce is a big plus for us. Obviously, that's a market trend. Lots of people are exhibiting growth in e-commerce, but I think our 49% quarter over quarter growth versus 2019 is reflective of some of the work that we've done to continue to try to improve and drive that business. And I can elaborate on some of that now or later if you'd like.
Definitely would like to hear a little bit more about that.
So I think some of the things that we've done is we redesigned and relaunched the Lilly Pulitzer website in 2020 to make it easier to use, easier to search, easier to navigate, easier to transact business on. We'll be doing the same thing. We're about to relaunch in Tommy Bahama with their website. It'll look beautiful, but it'll also function even better than ever. We've enhanced the mobile experience in Tommy Bahama and in Lilly Pulitzer with our new mobile app in Lilly. We've worked on our SEO, our search engine optimization in both of them. We've worked on our marketing capabilities, particularly as it relates to customer data and being able to take that data and ingest that data, analyze it, and use it to better target customers and better curate the content that they're seeing. Some of the other things that we launched last year in Lilly, we launched Instagram checkout, so social commerce. We implemented a social listening capability there to help us keep track of sort of consumer sentiment and attitudes about the brand. We're working on a number of data initiatives across all the brands, again, to enhance our ability to target customers and to give them the information they need and present the offerings to them that they're most likely to be interested in. So when you think about it, the big picture goals in our digital world are really about delivering a digital experience that showcases and leverages the magic and breadth of our beautiful brands. And then really a huge part of it is having a data-driven approach to identifying and connecting with audiences and curating the content that a particular audience receives from us. And that's a big part of it. And then finally, it's that integration between the digital and physical channels. The consumer, for the most part these days, really doesn't think of the digital brand and the physical brand. It's all one brand. And we need to make sure that we're serving her in a very one brand approach, and that she's able to pick and choose which elements of the experience she wants from digital, what she wants from physical, and sort of mix those two together in any way that she might choose to do, and still have a great experience with us. So those are a lot of the things that we've been working on and will continue to work on during this year, and really probably the following year or two after that. So lots going on in that front. And then there were other things as well that could help drive the results that we saw in second quarter.
So Tom, one of the most interesting things is the fact that you had an over 60% gross margin in the first and second quarter, better than 2019. Where is it coming from? What are you seeing in supply chain? How do you balance the two? And what are you seeing out there?
Yeah, so I'm glad you mentioned supply chain. Obviously, I think everybody out there is aware that there are a lot of challenges in supply chain this year. Great article in the Wall Street Journal today about that. They cited Nike in specific a number of times, but I think it's sort of emblematic of the challenges that pretty much everybody in our space is having with supply chain. So as good as the results have been this year, they'd probably be even better if we were able to get inventory in more quickly. And another challenge that you've read about a lot, I'm going to work it in right here, is on the people side, is just hiring enough people is a real challenge right now for us and others. We're doing all kinds of things to try to step up the hiring and the retention, but that's a big challenge too. In terms of the gross margin, it was a terrific quarter from a gross margin standpoint. We were very pleased to deliver an adjusted gross margin of 64% versus that was up 450 basis points, I think, over where we were in the second quarter of 2019. And that's really coming from a variety of different factors. I'm going to throw out rough approximations of what drove it. They will not quite add to 450 because I'm rounding, but about 300 of that was from more full price selling. About 200 of that was from mix, shifting more towards direct to consumer, so retail and e-commerce, which have higher gross margins than wholesale. Then about 100 of it was from improved initial markups or IMUs. And then we actually lost about 100 basis points from increased freight costs. And that's both on the inbound international freight side as well as the outbound courier freight costs, which I think, as you're well aware, those are increasing. So a lot of elements going on that are helping drive that gross margin. But if you'd like to, we can talk about it a little more. I think there will be some issues, I think, going forward, but I think an awful lot of that is sustainable for us.
That's exciting. Yeah, I'd love to talk a little bit more about what you're seeing, AUR, Vietnam, how you've diversified sourcing, or what does it mean for you?
Yeah, so the Vietnam situation is, I think most people know, Vietnam's a major source of apparel products for us and other of our peers. They have struggled of late with the pandemic and have had to shut down factories. There have been nationwide shutdowns fundamentally that are creating challenges in other parts of Asia, which are very important locations for sourcing in our industry. There are also COVID-related challenges. And what we're having to do in response to that is be very nimble, very agile, very responsive, and really do everything we can to mitigate the impact of those challenges that they have over there. So among those, the things that we're doing are re-merchandising our line to take advantage of the product that we can get, and things that are going to be delayed, we're either canceling them or re-merchandising them into later deliveries in the year. For forward-looking orders, we built more lead time into the orders, which is not something that we would ordinarily want to do. We've spent the last 20 years trying to shorten lead times, but at this point, just to make sure that we've got time to get stuff in, we're actually stretching lead times out. Many of the vendors and manufacturers that we deal with over there are actually multi-country operators. So they may have plants in multiple countries, and we're working with them. And in many cases, we've been able to shift some of our production from sort of the more challenged spots from a COVID perspective to places where they're more able to do business at this point. And I think the partnership that we've had with our factories and our vendors has been phenomenal, and I think, Dana, you can relate that back to the way that we treated them going back 18 months ago when this all started. And if you remember, initially they had the first shutdowns over there. And then we got into shutdowns over here, and that created supply challenges on their end and then demand challenges on our end. And through all those challenging situations, I think we treated them with the integrity and the respect that we value so much as a company. I think they felt like we treated them like a partner now, and they're doing everything they can to treat us as a partner now. So we're working closely with them. I think we factored all this as best we could into our forward guidance. So this is not really news at this point. But we're convinced we'll get through it. We'll stay agile and nimble, but we'll get through the next couple of months.
That's very encouraging. And obviously you have the great desire and demand for your brands from consumers. I think one of the other interesting things is F&B. Food and beverage has become part of your identity. People like spending time. They buy more clothing when they're at the Marlin Bar. What's your game plan for F&B?
Yeah, so great question, Dana, and one that we love to talk about. I know you're a big fan of our F&B efforts. Yep. And have been a good supporter of it, but we love our food and beverage effort. During the second quarter of this year, our food and beverage was up 26% over the second quarter of 2019. That was not all comp. We had a couple of places still closed versus 2019, and then we had 5 additional Marlin bars. But even on a comp basis, we comped positively. All locations that were open, I believe, were positive comps, and almost all of them were double-digit positive comps. As of the end of the quarter, we had 21 food and beverage locations. All of those, as you know, have a store attached to them. At the end of the quarter, that was 7 Marlin bars and 14 full-service restaurants. At this point, we have completed the conversion of the Las Vegas location from being full service to a new location within the same center, but it's a Marlin bar. So now we got 8 Marlin bars and 13 full service restaurants. And then if you look at those, Dana, together with the retail stores that are attached to them, that comprises about 25% of the Tommy Bahama business. And in the bricks and mortar world in Tommy Bahama, this is going to be our emphasis is on growing those food and beverage locations. So they already account for 25%. I think that'll grow over the coming years. And then when you factor in the impact that they have on our digital business as well, so that people that get introduced to the brand through those locations that experience the full beauty of the Tommy Bahama brand while having a meal and a cocktail or two and a little bit of shopping and getting fully immersed in the brand experience. And then they take that with them back to wherever their home is and become dedicated customers for life. So this is a very important part of our strategy. We love it. We talk a lot in our company about hospitality, and we can deliver that through a retail store as well. But there's nothing like breaking bread with our customers and sharing a drink with them to really cement that relationship and their true emotional attachment to the brand. So more to come on food and beverage. We love it. We're pleased with the results that we're getting. And when you look at those numbers for second quarter, keep in mind that a lot of these places are still operating under some kind of restriction in terms of their capacity. They've got huge challenges with staffing, as any restaurant anywhere in the country does these days. There are lots of challenges, and yet we've been able to really deliver some great results for our company and our shareholders, and have delivered an awful lot of happiness to our customers. That's really what I look at every day when I look at our flash report. I always think of it in terms of how much happiness did we deliver yesterday, and especially when I look at that restaurant flash, because it's been a tough year and a half, and people really need that escape, if you will, and we provide that to people each and every day.
Tom, it's great to hear the update on Oxford and how you're coming out in a winning way with all of the brands, with all different channels of distribution and enhanced products, and frankly, an enhanced financial profile. Thank you so much. We look forward to continuing to follow the happy path of Oxford going forward. Thank you for joining us today. And at 3 o'clock, we'll have Clarice on at the Share Conference. Thank you, Tom. Thank you so much. Great to see you.
Thank you, Dana, for hosting us. We always love talking to you. Have a great day.
You too. Bye.